Great having you. Thanks so much for joining in. Uh,
Thank
this
you.
morning there were two or three key things that we were talking about, right? From the Delhi explosions that happened to Warren Buffett hanging up his boots from writing things to Donald Trump putting out yet another post that US and India are very close to the trade deal. Now we thought that from a market's perspective that post is important, but maybe not so because now there is no clarity of whether there is a trade deal very close or not just because Donald Trump is saying. How are you penciling an announcement of that nature with what the markets could do? Because clearly that's one thing that the markets are looking forward to.
Well, I'll not overemphasize the impact of trade deal. It is important, and Niraj, it will come in some form, right? This is largely around agriculture. We are not going to open up very clear around that. And it's not that it's going to end with one silver bullet over there. So these negotiations will continue. There could be phases in terms of how the trade deals are constructed. My sense is that the bigger problem impacting India seems to be that you're on the other side of the AI trade. So, and I am personally, not a big believer of this AI bubble and stuff like that. I may not be equipped enough to take a call on the valuations and all. But there is no doubt that the underlying technology is profound and we have zero play over there. And as a matter of fact, like I said, we could be on the wrong side of the impact of what can happen because of AI. That's a bit of worry for me. A lot of the issues that we're talking about in terms of trade and stuff like that, we can handle that very well. We're still growing at about 6.5, 6.7. They are important. You need to have the right kind of relationship with the richest democracy in the world. But I don't think that that's the pain point, actually.
It's an important point, Nirav, because we don't know if the trade deal will come first or the Supreme Court saying that the tariffs were illegal in the first place will come first. So keeping that aside, would it be fair to say that the big factor for Indian markets right now is corporate performance? And what Q2 has shown us. We just put out a list of surprises and shockers before we had the conversation with you. It's fair to say that this had quite a few positive and negative surprises this quarter?
Absolutely right. So I think broadly from, if I run some numbers in my head, I think consumer discretionary has done well, oil and gas has done well. And those are sectors that have done well, right? But you clearly don't have the kind of momentum that you need either for banks or for IT. And these are big sectors. I'm talking about Nifty. And that's the problem, right? So if your earnings for the key sectors are growing at about single digit or high single digit, there is only so much momentum that you can have in the narrow market, right? But I still feel constructive on the broader market. So I've got a different view over there. And I've been holding that view for some time. That India is largely a story of diversification away from this large cap concentration. Till the time that you've got new companies coming in, you had Lenskart and platform companies. Eventually, they'll become big enough and be a part of the Nifty and take the momentum.
Are you positive of the IPOs of the world that are deluging? When you say new companies, do you mean IPOs? Where did you stand on the entire valuations debate since you spoke about Lenskart?
Well, there is a market. So, I'm a staunch believer in capitalism. And then, if there is a free market pricing, who wants to sell can go and sell Lenskart. Who wants to buy can go and buy Lenskart, right? So, no one is putting a gun on your head and asking to buy something, right? Just about 6 months back, you had a case where I think Ather Energy, the bankers forced down the valuations or the investors forced down the valuations. And the stock has doubled from there, right? So, for me, the bigger part is that different business models are getting listed. Now, we can argue that valuations are ahead of the story. In some cases, the story is ahead of the valuation. But that's fine. We are talking about some of these business models which have got very, very strong competitive moat. And probably they are looking at global plays as well.
And that's a fair point. I mean, the management or the bankers decide the valuation up to you, whether you choose them or no. And some of those IPOs have worked well. I think, Nirav, the question that probably comes in is a lot of times retail tends to follow, wrongly, rightly, what have you. Great names in the anchor book, etc. And a lot of those IPOs are actually trading below, right? Which is why maybe this conversation comes in so many times. But fair. The other question is this morning at least, is what Bajaj Finance has said in the con call. And everybody's talking about how lending businesses, NBFCs, will have a great run because the GST cuts will induce consumption spur, plus the RBI has already done what it has done, which is beneficial. And yet, the principal premier NBFC name is talking about a small but a downtick relative to what was expected. Could this hold true for the whole NBFC space, therefore? And is there, therefore, caution or
Think LinkedIn is only for job applications? Think again. Trust me, it's so much more. It's actually the holy grail for finding
hats off to Bajaj Finance, for pushing growth rates at what they are. They've done some 25% compounding for such a long time. And it has surprised me. Think of it, their customer franchise today is 120 million. For most of the products in India, you tend to pick out at 30-40 million. We are talking about 50% household penetration. Now, how many guys can actually take Bajaj Finance loan at the kind of margins that they want and at the kind of credit costs that they want? Right? So frankly, if you ask me, my analysis is downgraded the stock, right? So frankly, if you ask me, think of Paytm, the monthly transacting users are 75 million, Zomato 30 million, customer franchise of Bajaj 120 million. So they've done a great job for such a long time, but it is natural that, your addressable market is shrinking, right? And therefore, at some point of time, your growth rates have to has to reset lower. It is natural. Now, when you look at Hindustan Lever and soaps and detergents are growing at 2%, it will only grow at 2%.
Okay, fair call. So, Nirav, I'm just trying to get an inference from what you said. Are you therefore constructive on the NBFC space by and large, showing decent growth over the course of the next 12 months or 18-month period?
Absolutely. So I believe that there are a bucket of NBFCs which are able to operate at low NIMs, low credit cost, and most of them are compounding between 20 and 25%. And they stand out because none of your private sector banks are growing at more than a high single digit, right? And some of the stocks have done well. It's in public domain. You talk about Aditya Birla Capital, you talk about L&T Finance. So AAA corporate rated, with low cost of borrowings, I think they're growing fast and they're competing with banks. And if you actually go to one level of detail, what I call the cost of loanable funds. So if you adjust your OPEX to a cost of the funds, they are not too far away from some of the large cap private sector banks in terms of overall cost structure. So to answer your question, more constructive on NBFCs, and also because of the fact that I believe that you will have lower interest rates as you move forward, right? So which means that the earnings recovery in private sector banks are likely to get pushed out. That's the construct of the business model.
You spoke earlier, Nirav, about seeing more momentum in the broader markets rather than in a small group of stocks or the large caps, so to speak. What pockets are looking interesting to you and where you are constructive at this point? Or is it very, very scattered and there's no clear sort of theme? Can you give us a little more detail on that?
So, I have been now constructive on platform companies for a while. I think in the next 5-10 years, as a sector, they will be very, very big. I think people are underestimating the margin profile that these companies will have over the next 5-10 years. They have got the lowest cost access to the consumers, right? So I don't want to get into too much of details around that, but that class is emerging a big way. I am still very constructive on manufacturing in India. It's just that these things tend to play over decades. You've seen now Apple iPhones, doing about $30 billion, and you will get, you sort of have a more backward integration. I'm constructive about the solar theme, right? So these are 15-20-year decadal stories, right? We are not too far away when your price of electricity will, in nominal terms, will start declining. Right? If I'm not mistaken, now the BESS tendering of renewable power is very close to thermal power. So these are big themes. So, but then you need to get outside, the narrow focus that people tend to have on Nifty.
So fair enough, but I want to
I'm
come back
considering
to
cement, for
I
example.
want to come back to platform companies, because again that is something which has been the topic of a lot of hot debate. So you are fine when a platform company says it's going to raise a large amount of funds just a year after it's listed, and there's no clarity on profitability. You say that's okay, that's what we need, because some say it's a cash burn and market is funding its cash burn.
So I'm saying is that so it's a market, the Tamanna, right? So I'm saying that I have confidence in the unit economics. Some of the guys may not have confidence in the unit economics. So that's a call.
No, fair enough,
Right.
fair enough. I'm just trying to understand the call, because what we are planning to do here, or what we aim to do, is give our viewers divergent views. Then they can make up their mind. So, which is why I'm trying to understand that call.
Absolutely. So let me give you some perspective, right? So
Yeah.
if you look at DMart, for example, DMart works with 12,000 rupees per square feet of capital employed, right? If you look at Blinkit works with about 4,000 rupees per square feet of capital employed, right? And if you look at their mature stores, right, they are doing about 35% IRR, right? So, and the thing is that what you're looking at is looking at a portfolio, because you're making money in 10 cities, but you're opening you're opening dark stores in other 30 cities. I have seen this earlier in telecom, right? I was a telecom analyst way back in 2002, and Bharti was going nationally all over the country, but you could sense very strong economics in the Mumbai circle, in the Delhi circle, and the rest is history. So if you're convinced about the model, and I am very clear, there are going to be bouts of competitive pressures, someone will get aggressive, but by and large, the way I look at it is that quick commerce, for example, I think they stand a better chance in India as compared to traditional retailers. Secondly, I've got a strong view that tech companies will end up learning businesses. Business companies will never end up learning tech. It doesn't happen. It has never happened anywhere in the world.
Okay. Well, those are strong statements. And Nirav, it will be lovely to do this conversation 3, 4 years, 5 years out to see how way the cookies crumble. But, that's why we love talking to you. Some very interesting views. The same today. Thank you so much for taking the time out and being with us.
Thank you so much. Appreciate.
Yep. Well, as we wrap up the show, though, viewers, what's